tax treaties are aimed to be aligned to the international tax standards. Just try to imagine how many tax treaties are concluded around the world and what if we need to bring some changes to almost all of them. For sure it will be a never-ending exercise if countries want to renegotiate each tax treaty with the other treaty partner to bring in intended changes within the existing tax treaty framework. Such measure will be inefficient and lacks consistency, besides being a very, very lengthy process and endlessly done. And here's the job of the MLI. So let's understand together, what do we mean by MLI? Also, what does it mean if a country signed up to the MLI? And also how it works. Hello everyone and welcome to the TaxGate. Hit the subscribe button and let's get started. Well, the MLI stands for the Multilateral Instrument, which would be considered as a master template or a unified layout to bring in changes alongside the existing bilateral tax treaties. Also, MLI is one of the BEPS 15 actions that were developed by both G20 and OECD under BEPS project to tackle harmful tax practices by fighting against tax avoidance, also improving the consistency of international tax rules, and also to ensure a more transparent tax environment. You would understand a little bit more about BEPS project by watching this interesting video. Good. So, as we were saying, that MLI will apply alongside the tax treaty and will modify its application by allowing the participating country to implement BEPS recommendations without renegotiating or amending each and every relevant treaty solely with each treaty partner. So, it should be crystal clear that MLI will not replace the existing tax treaties. As we were just highlighting, that it will only apply alongside the existing tax treaties, and either it will modify or supersede or even supplement the application of the existing tax treaties in a synchronized manner, just to bring them in line with BEPS measures to address and to help fighting against base erosion and profit shifting, and to ensure that tax treaties are aligned to the international tax rules and standards. Well, so here MLI enables a quick and consistent implementation of the tax treaty recommendations by enabling the participating countries to swiftly and efficiently modify their network of double tax agreements to address the tax treaty's BEPS issues and concerns such as tax treaty abuse, the artificial avoidance of permanent establishments, and also working on preventing tax avoidance and improving dispute resolutions as well. Good. So, the purpose of the MLI here is to preserve the role of the bilateral tax treaties in eliminating double taxation worldwide and at the same time combating the opportunities for businesses to use these treaties to totally eliminate the tax liability or to aggressively reduce the tax rates to low levels. Well, that was a quick introduction to the multilateral instrument, and now let's understand how does it work. MLI implementation would be as follows. Once the participating jurisdictions sign the MLI, then accordingly they will be required to identify which agreement of their tax treaties they want the MLI to apply to and modify, and that's what we call the covered tax agreement. And here what we mean by a covered tax agreement is the tax treaty already in force between the participating countries where both parties have made a notification that they wish to modify the agreement using the MLI framework. So, it is clear that MLI changes will apply only to the covered tax agreements just as agreed between the participating jurisdictions. And just to highlight that even when the tax treaty is a covered agreement, still the MLI gives a considerable amount of flexibility to the countries to tailor how they want to adopt it just to fit their economic circumstances. Well, let's now move to the next step. So, once the covered tax agreements are determined, then each participating country must notify the OECD of the bilateral tax treaties that specifically wishes to choose and assign as covered tax agreements. Also, these countries should choose and assign which provisions of the MLI they wish to adopt for each covered tax agreements at the time of signing and ratifying the MLI, and that's what we refer to as MLI position. And here let's understand what do we mean by MLI position. Well, some of the OECD recommendations under the MLI are known as minimum standards, which mean that they must be adopted. Also, there are some other provisions that are optional. And here jurisdictions can choose either to adopt the minimum standards only, or they can choose to also adopt some or all of the optional articles. So the signatory countries have the right to make reservations against some provisions other than those that are included within the minimum standards. In other words, the signatory countries have the right not to apply some of the optional articles, and that's briefly the MLI position. Great. That was a quick introduction to the multilateral instrument MLI. More interesting tax videos are coming. So like and subscribe if you would like to see more interesting tax videos, and thanks for watching TaxGate. Tax